May I request Mr. Nikos Kavalis, Metals Focus, to come on stage to launch Gold Focus and also present a brief summary before he joins the conversation later. Mr. Nikos is the Managing Director, Singapore, of Metals Focus. He is a founding partner of Metal Focus, and he has over 18 years' experience in metals analysis strategies with GFMS and the Royal Bank of Scotland.
Hi, everyone. Thank you very much for braving the polar temperatures of this room. And I think if we all make a joke about it, maybe eventually they might sort it out. So keep doing that, all speakers. Anyway, many thanks to the organizers, as well as the SPMA, of course, for hosting such an amazing event again and for giving us the honor of providing a platform for us to launch our little report, the annual Gold Focus. I'm also delighted that the 200 copies that we put at the registration desk disappeared before I actually even made it to the registration desk. And I wasn't that late this time. But yeah, it was very nice to see people have interest in our work. What I'll do is I'll go through some of the key findings of the report, basically run through some of the key supply-demand developments that we saw in 2024, as well as give you guys a brief review of how we see this year panning out. Before I do so, a brief thank you to all of our sponsors. Valcambi continues to be the front page sponsor of this of our annual Gold Focus, has been for many years, but also everyone else that contributes to our work. Without their support, none of this would be possible. I'll start with a brief review of prices in 2024. I think obviously all of this has been overshadowed by the breakneck rally that we've had in the last few months since the start of the new year. However, we can't forget that this shouldn't make us forget that 2024 was an exceptionally strong year for gold prices. The annual average was an all-time record. And look, while understandably reflecting this high price environment, total physical demand did suffer some pressure. It basically stagnated, and again in 2025, it's inevitable that we'll see some declines. If you convert these volumes into values, as you can see in the blue line over there, we've had a multi-year increase in the amount of money that the world is spending on gold, whether this is in jewelry investment or whatever central banks are buying, which is, this trend is continuing through to the present time. Last year, we also saw professional investment. Last year, we also saw Western professional investment turn quite positive towards gold after a couple of years of being quite lackluster. But we saw pretty good interest both in futures as well as from let's say, May onwards, ETFs from Western investors. This, of course, reflected the extremely positive macroeconomic and geopolitical environment that we had for the metal. So if we look at the top line or the headline overview of the market fundamentals, supply for the first time breaks over 5,000 tons into a new all-time record. This reflects a new all-time record for mine supply, as well as an increase, quite modest in my humble view, of only 11% in recycling. Still the highest since 2012, but considering how strong prices were, I was actually personally surprised to see such a moderate increase in recycling. The more, let's say, positive side is that in spite of the very dramatic increase in the average annual price, gold demand declined by just 2% last year. Official sector net buying again exceeded 1,000 tons for the third year in a row. And we saw a modest gain for physical investment demand, which we'll discuss in a minute, but that, considering the price environment, that was a very positive development. The more negative side to the story was, of course, jewelry, where once we take out COVID, that was the largest decline we've seen in a very long time. Official sector, of course, remained the standout performer in the market. The trends of de-dollarization, whether this is for portfolio diversification purposes or for what I like to call geopolitical diversification purposes, in the aftermath of Russian reserves being locked out, there's a very clear appetite for gold. And look, although we saw some decline in gross purchases last year, we also saw a pretty dramatic drop in gross sales, as we didn't have the sales that we saw from Turkey in 2013. So the figure was very healthy on a net basis, and in fact slightly up year on year. Physical investment demand has been quite mixed. We see a very dramatic divergence between East and West. In Western markets, we're seeing selling back or buybacks, liquidations by investors, keep the net investment figure under pressure, whereas in Asia, remarkably, we're seeing investors aggressively buying into the rally, something which we've seen continue into this year. Jewelry consumption has understandably taken quite a big hit. And look, the reality is that when you're a consumer and you're going out to buy jewelry, you never think, oh, I want to buy X number of grams. You tend to think, I have this much money left after I've paid my rent, my kids' school fees and all, and everything else, and that's what I need to spend on jewelry. So when the gold price is up by 30, 40, 50%, naturally the fixed amount of money you have will buy you less. Western demand is less affected by this because the markups in the West are so much wider than what we're seeing in China, India, and most of Asian markets, so retailers and manufacturers can absorb part of the rally. I think talking about 2024 and 2025 and not mentioning tariffs would have been an omission, and we did see. We all know that the EFP exploded in the aftermath of the US election. Things have calmed down, perhaps more relevant for the physical market than the actual EFP was the fact that a lot of metal moved away from the London market, from the London pool of liquidity, and that put immense pressure on lease rates, and that really created a lot of issues earlier in the year for refiners as well as users of metal. Let's have a quick look at 2025 and what we expect. Look, in the face of further increases and what is, without a doubt going to be another all-time record for the gold price this year on an average annual basis, naturally we're seeing appetite or efforts to supply more increase. We have a new all-time record for mine production, and we do have some increase in recycling, but for those of you that were around in the market back in the 2009 to 11 rallies, you will remember that the amount of scrap that we saw was just impossible to process. I mean, there was a deluge of metal. And we're really not seeing that. I mean, in fact, visiting many of our friends in the Asian markets, which should be the most price elastic, and the amount of recycling that we're seeing is, it's increasing, but the gains are quite modest. I think the most significant development this year in terms of supply-demand realities is the sharp decline in jewelry fabrication. This will be. Our statistics only go back 15 years. If we exclude COVID, we haven't seen another such bad year. We have to go back to figures that our predecessors, GFMS, were producing to see such low jewelry fabrication numbers in volume terms. Now, you are seeing a decline in official sector buying, but I need to point out that we expect the absolute figure to be very high historically, still. And I think the most interesting thing that you can see there is that green square above physical investment. Again, this reflects the extremely strong appetite by retail investors to buy bars and coins. And just a little anecdote for you, the first quarter figure, if you measure it in value terms within Asia, bar and coin demand was actually higher than it had been in 2013 during the all-time record in weight terms. Very quickly, to touch on the fact that investors remain very positive towards gold. U.S. debt concerns put question marks about the sustainability of the U.S. debt pile and what this means for the U.S. dollar long term. The back and forth flip-flopping of the Trump administration on tariffs creates a lot of uncertainties. And while inflation hasn't really been a problem, there are concerns that the tariff environment will create issues later on. Last but not least, the expectation is very solidly that we'll see some more cuts from the Fed. All of these factors are very positive for gold, and you can see this. Reflected in institutional investor, hedge fund investor, CTA behavior in Western markets. So in this environment, I think it's very difficult to not be bullish gold, and unsurprisingly, we are bullish gold. I should also point out that this is on the basis of our forecast, as you see it now, is on the basis of the tariff situation normalizing eventually, and also let's say more aggressive conflict in the Middle East being avoided. If any of these, let's say, wild cards were to emerge, we could see much higher prices than what we're seeing there. And with this, I would like to thank you.